Hello and welcome to the first video of this brand new channel where I hope to uh, discuss dividend-based investing, probably other economic topics, maybe occasionally delve into politics. But what really motivated me to finally do something was all of the conversation in the investing community regarding these high dividend paying, generally option strategy based funds, exchange traded funds, like those associated with YieldMax, most notoriously, Roundhill, Defiant, and others. But I wanted to try, I always want to go through and look at the data and understand things myself to see what's happening and understand what constitutes a good investment and what doesn't. And that's what kind of prompted this video. There were also a couple of other topics that I want to cover, and those include NAV erosion and return of capital, what difference it really makes getting monthly versus weekly distribution from funds, and then we'll go into some details in the data relative to what the actual investment results versus the expected or advertised outcomes from some of these funds are. Not an exhaustive list we're covering here for lots of reasons. It's a lot of data to go through, and I kind of just want to get things started and then maybe see what everyone else would like to see. So feel free to put in the comments, or feel free to email me. My email address there is at the bottom, financialfreedominvestormedia@gmail.com. Would love to hear from everyone, and would love to see what kind of conversations maybe we can get going. As of this moment, this will be the first video. There are no followers. There are no likes. If you find this content useful, interesting, or would like to see what comes along next, please go ahead and like the video and subscribe to the channel, and maybe post in the comments what you'd like to see in the future. As always, general disclaimers: not investment advice. It's for illustration, education, and entertainment purposes only. Timing of transactions could impact results. In particular, in some of the examples I'll show, I used the X dividend date as the reinvestment date, mostly for simplicity, but also in some of my own transactions, I know what the dividend's going to be. A lot of times I'm trading in a margin account, so I just go ahead and buy. I don't auto drip. I go ahead and make the purchases myself, because a lot of times I'm increasing the investment beyond what the dividend would be anyway. And in a margin account, or if you have the cash available, you can pick them up at the low on the ex dividend date and not have to wait for the distribution to actually hit your account. But that's just me. Probably will change the date over time to maybe show the difference in what that would look like. Yeah, I use Seeking Alpha and Yahoo Finance to download and look at a lot of data. So those are sources that are believed to be reliable, but may not be, or may be prone to error. Past performance, as always, no guarantee of future results, whether they're good results or bad results. YieldTy. So being realistic, this is something, I think if it was possible to put money in a mutual fund, leave it and forget it, get 100% or 60% return every year. Only a fool wouldn't put every last penny they make in that fund and be retired in 5 years, right? Everybody would do that. So I think we need to be really realistic about what to expect from these funds. As we know, anyone who follows the tasty trade guys like Tom Sosnoff, or maybe someone that's a little more conservative and systematic in what they do, and who I always enjoy following along some of his trading ideas, Tom King on the Tom King Trades channel. We know that someone getting 25, 30% return a year, even trading options, is phenomenally happy usually. So we have some unrealistic expectations, I think, that have been set relative to some of these high yields. And again, does not mean they can't be achieved in the short term or maybe the long term. But I think we just have to be realistic and have to be ready. You don't want to necessarily go all in. You want to be ready for when a downturn happens or when a fund manager makes a mistake or whatever else. So and because of the decline in the underlying value of some of these funds, it's not going to work out. I think we've got some people out there who thought they were going to take their nest egg, dump it in these funds, and live off these distributions that are coming out. But unfortunately, in many cases, these distributions are eroding the underlying value of those funds, and this is just may not work out well in the long term. So this is not a good idea to plan your near-term retirement on dumping all of your money in CONY and AMZ and YMAX. Obviously there are strategies though, if properly executed and you get really good and maybe get a little bit of luck. Depending on your account and how you're set up, you can leverage some good returns into some really great ones. But if you're trying to double your money every year, just remember the old advice: bulls make money, bears make money, pigs get slaughtered. Not saying you can't make a lot of money, just understand the odds of consistently getting these blowout, 60 or 100% returns that are being advertised, but may not be what's really happening behind the scenes. We hear terms like NAV erosion and return of capital. I don't think I've perceived people using these interchangeably, but just want to make sure that everyone understands they're not the same thing. There's tons of reasons, usually associated with tax treatment, and it's another reason to hate the income tax because it's evil and complicates everything. But there are reasons, generally again related to tax treatment, why something might be labeled a return of capital. There may be regulatory reasons why why capital has to be returned. For example, there may be unrealized gains that have to be accounted for that maybe they don't want to sell the underlying yet, or just all kinds of things depending on the fund, the strategy, what their prospectus says they're going to do, what they're required to do. There's a couple of links I posted here, one at Seeking Alpha and one at Fidelity. I've liked both of them, sharing them here with you. I think they're good to read on the subject. I'm not sure they completely demystify it, but certainly help. And then NAV erosion, obviously one of the issues, and something's being talked about by anyone really paying attention to, especially YieldMax, but certainly not them exclusively. They're just popular right now and hot in conversation. But when these distributions are greater than the fund's actual earnings over a period of time, you're going to get erosion or a declining net asset value. And then again, there could be structural or regulatory challenges to a fund that or strategy thing that's contributing to why this is happening. If it persists over the long term though, and the distributions aren't covering that, you're going to eventually have a bad day. So, and another thing to consider is, the strategy just might be bad, or they might just not be good at what they're doing, or they're setting their strikes wrong, or they're, continuing to tweak. I don't know. This is the sort of thing I would really like to see addressed seriously in maybe any upcoming interviews or anything that someone might have with, especially Jay from YieldMax. He seems to have been accessible to some of the other investment dividend content producers that I follow, and certainly appreciate their efforts and his willingness to engage with folks. So anyway, something to be careful of. Specific to NAV erosion, though, Roundhill Investments. There's a link here to a blog article at their website that talks about distributions and specifically focuses and mentions NAV. And I think that's certainly worth reading. Monthly versus weekly distributions. This has come up consistently. I think people want to be able to compound the weeklies themselves, there's these are basically the numbers as to how much difference that can really make. In conversations with YieldMax, I know there's been some resistance to them looking at doing weeklies like Roundhill is doing. I like the weeklies, but but I have a touch of ADD, so it gives me one other little thing to do that updating the numbers makes me feel good, and I but at their return levels, the compounding itself isn't necessarily going to make a huge difference. The Another thing in regards to that, though, is that different timing cycles may be helpful. So someone may want to get their distribution from one fund, take that distribution, instead of dripping it immediately into the same fund, drip it into the one that pays out the following week or tomorrow or whatever, and maybe cycle through. I mean, there's different things people could do with that money and timing to try and maximize returns, or make sure they have money available to buy something on an ex-dividend date when the value drops, or whatever they're trying to accomplish here. But if you look at this, and again, any observed issues with my calculations, math, approach, methodology, please put something call me out in the comments, send me an email, let me know. Happy to have that conversation and make sure we've I've got things right here. So, but if you look at the variance compounding monthly and weekly, even at 20% annual rate of return, you're looking at 0.15%. And don't get me wrong, I'll take 0.15%, but if someone else is going to compound the money for me, they can have it. But you start getting 40% is a little bit of a difference, right? We'll take almost an extra point in any investment we've made. But you get up to 60 to 80%, as you can see here. You start getting into a significant enough difference to where compounded over a number of years, that's going to be real money to somebody. So if you're talking about wanting to compound, the money that CONY is spitting out or something, and do that weekly instead of monthly, you might have a fair argument there. Although I think as we'll get into some of the numbers here, CONY might need to hang on to as much of the money as possible to keep that value up. We'll start off doing just a quick review of ULTY here. As you can see, that's a lot of numbers. It's a little mind-numbing. If someone has a suggestion on a better way to look at this, better way to structure the data, or what you need to see or don't want to see, I'm open to suggestions. I really started doing this for my own benefit, and I said, I enjoy watching some of the stuff some of the other people put together and looking at some of the data they produce. Let's put this out there and see if we're all looking at this the right way or not. So just very quickly here, you've got the inception date, which was for ULTY was just February of this current year. I tried to base all of these on a starting investment of about $1,000, which I believe in ULTY's case would have given us about 50 shares at 20 a pop. If we look across here, the total per share dividend since inception is $6.67. However, the per share price change, as you can observe here, going from $20 down to $10.98. I'm not sure why it says $9.26 instead of $9.02. Actually, I do know why that is, because there was a trade date that's probably behind the scenes here on the first day of trading where it was up as high as 920 in the 920s. So something I probably need to fix going forward. Regardless, if you just bought and held that 50 shares, your $1,000 would now be $870.45. If you had been reinvesting the dividends along the way, you actually would be worse off, almost $845. The reason for that is you're basically just reinvesting that into an asset that the value is continuing to decline in. We can look at the profit and loss figures here. For the purposes of this sheet, this is just a simple annualized calculation based on days of the year. There's a summary sheet at the end of this where the annualized calculation is done a little differently. It's based on months instead of days. produces slightly different result. But at the end of the day, I think you get the gist of what's going on here. Also, these two figures here, average monthly change and average change value, are two different things. The average monthly change is from month to month, basically, or ex dividend date to ex dividend date, how much the underlying asset averaged going down. This average change value, though, is an average of those actual percentages. I think as most people involved in investing who understand gains and losses and things understand, if you take an 8.7% loss, even if you'd gotten an 8.7% value increase the next month, you would not have made that loss because that gain would have been on a smaller dollar value. So that's why I think those two numbers are different, because the average change value is basically just averaging, how much it went up and down month to month. And, again, just a piece of data that may or may not be useful to anybody. So ULTY, we can see here, is challenged. We'll move on to CONY. CONY is one of the funds that has actually been successful for people who have put money into it. Initial $1,000 investment. Whether you bought and just held on to the shares, you actually would be a little bit better off by about $56 over reinvesting the dividends along the way. I know, and again, I'm looking for flaws in how this was done, because I don't think that's what people were expecting. I think there's a lot of people thinking, well, if I just keep compounding this money in there, we should be doing well. But the problem is that this value, per share values, continue to erode. The total per share dividends is 1953. I think one of the reasons that in particular here this looks better is that if you put your initial $20 in, held the shares, and just collected the dividends, you've gotten almost all of your investment back, which is phenomenal. That's just absolutely amazing. If you had continued to reinvest in the fund, though, you can see the share prices went up and then fell from there. And that's why you see the reinvesting dividends return being slightly lower, because you have shares you bought at way more than $20 a share, up as high as maybe 26. And so that's producing these different results. Regardless, you're still looking at something in the 56 to 62% annualized returns. And again, that's just based on days the fund has been active. So not horrible for CONY, but we do want to look and see what happened here, because you've got this big value change. Let's see here, going from X dividend date to X dividend date. You got a $4 drop on this, and that's significant. In fact, it's enough to make that to take the annual return from, if we'd done this in July, you'd be sitting at 110%. Now you'd be down at 66%. We did just get today. We did just get the distribution payment for CONY at $1.04. But this data either isn't available or hasn't been populated yet. We'll get the XDiv populated today. Update this stuff, and probably around mid-month, once we've got YMAX and ULTY's results, we'll update all the data and post that out there. I might do something in the interim. Again, if you want to follow along and kind of see where this goes, feel free to like the video, subscribe to the channel, and if we get enough interest, we'll keep putting information out there. YMAX has done okay. This surprised me a little bit. We've had the per share value go from 20 down to 17.65 as of the August ex-div date. We've collected $4.44 per in dividends, but they only had about a $2.70 drop in value. Now, again, this is continuing to change, continuing to evolve as with the market. We'll get the the September update in here and see where we're at. But as of September, was looking at about a 10% return. So your $1,000 would be up around $1,100. Again, and oddly, not much difference between a buy and hold value and reinvesting the dividends into the fund. And again, that's because the dividends really are just kind of barely given the advertised return of these funds, right? Barely keeping ahead of the actual loss in share value. But on the way this was calculated here from a return basis, you're looking at 15, 16, 17%. We'll see if that keeps up. I'm not especially optimistic. QDTE. So there's been tons of conversation about QDTE and XDTE from Roundhill and relative to whether those might make better investments than some of the YieldMax funds. They do weekly, so we've got a ton of data here. These funds came out in March, so we've really just got about 6 months worth of data, which isn't really a long enough time to fully evaluate, but you'll get some idea. So your initial $1,000 put in March, again, should end up right around $1,060. Annualized, you're looking at 12 to 13% returns, again, based on how this was calculated. We'll have a slightly different number in the summary sheet coming up. You can see the return rate continues to go up here in this far right column. Sorry, I don't have a label on that. I'm not sure why, but that's good, and hopefully that continues to increase. And at this point, you'd have gone from starting with 21.7 shares. You'd be up having about 26 shares at this point. Accumulated dividends, $7.66. But again, even with this fund, you've had the underlying share value go down by almost $5. So, if that wasn't as big an issue, this one would really be knocking it out of the park. Although I think it's still doing pretty well. XDTE. So this is the daily 0-day expirations that they trade on the S&P versus the QDTE, which trades on the Qs on the NASDAQ. This has held up its asset value much better. I suspect because the volatility is different than it has been on the Qs. Although even with NVIDIA making up such a large portion and some of the volatility it's had with earnings releases and things like that, and I don't mean volatility in a negative from a negative perspective, but I mean blowing it out of the park and potentially blasting through strike prices. But if we look here, again, approximate $1,000 initial investment got you a little over 19 shares. You would have collected almost $6 per share in dividends. But the underlying value, and again, this is as of end of August, okay, the end of August distribution, you'd have only lost about 59 cents. So this is phenomenal, right? Because this is an annualized return. Keep your dividends, sell the shares you've got, and on an annualized basis, you're right in the 20% return arena. And I don't think no one should be upset with that. And we see over here the return, a little bit of dip here first few weeks in, but has continued to go up, and they seem to be doing a good job there. So, and again, initial $1,000, you're up to about $1,100, and you've done that in six months. This is the summary sheet I put together. There's plenty of opportunity to add other things to this. If there's something you would like to see on here, I think maybe send me an email, put something in the comments. We'll take the most popular requests and maybe add them to what's being tracked. But looking at the YieldMax funds, CONY, I've got GDXY on here because I've already started doing some of the data for that. Some of that's because I have I own some shares personally. But if you look, annualized rate of return, again, we're up around 60% for CONY. This rate of return was calculated a little differently than the others. This was based on months, probably rounded, rather than actual calendar days. So we're going to get slightly different results here, especially since we're we're at the end of the cycle. GDXY, I was surprised this number was a little bit lower than I thought it was going to be. ULTY, poor ULTY is lost and needs help. You're going to be down 30% if you've invested at ULTY from the get-go. And that's despite having collected all those distributions, $6.70 in distributions per share. For something that started out the share price it did $20. I mean, that's big. But the problem is that underlying asset values continue to erode, and so you put your $1,000 in, you've got 845 of it, even though you own more shares now. YMAX is hanging in there. We've you're looking at almost a 17% annualized there based on how this was calculated. Roundhill, so QDTE, XDTE. Again, if you put $1,000 in, you're ahead on both of those funds. You can see XDTE has performed, but not just a little bit, but quite a bit better up till now. And again, a big part of that is because these distributions weren't trying to cover massive erosion in the underlying net asset value. QDTE has struggled with that. But again, you're talking about annualized rates of return, 15, 26%. Bring it. RDTE, I know there's a lot of excitement because they're going to have a similar fund to these other two that will trade tracking the Russell. I think with interest rates falling, I think small cap stocks have an opportunity to do really, really well if the economy doesn't collapse. As our fine friends like Steve Van Meter and others maybe suggest all the time, and I love watching some of those guys, but you just no one can predict what's going to happen. But looking for that RDTE fund to launch sometime soon here. That could be rumor and speculation was it could have been as soon as today, but it's expectation has been early part of September. So we'll see what happens there, and then and again for personal reasons, and then I think because it would be worth tracking. I want to put SPY-T on here from Defiance, and probably some other funds we should add in, and be able to track over time and see how they're performing and what's happening to the underlying asset value and whether it makes sense to continue on or not. Like I said before, questions, requests, critiques in the comments are great. An email's fantastic. financialfreedominvestormedia@gmail.com. Again, if you found any of this useful or want to continue seeing things as they get updated, these will hopefully end up being maybe slightly shorter videos. Subscribe and feel free to send me a note if there's something in particular you'd like to see. I hope everyone has had a great day. Good luck in the markets, and we'll see you on the next post. Take care.